Welcome and thank you for joining us today. We are about to dive into an exciting topic that can help you level up your trading skills. Today, we will break down how to use the side volume indicator in RTrader Pro. By the end of our time together, you will understand how the side volume indicator works, how to set it up, and how you can use it to improve your trading decisions. Are you ready to unlock the secrets of the side volume indicator? Let us get started. Have you ever wished you could see exactly where traders were most active, where the real action was happening? Imagine knowing exactly where buyers and sellers were fighting it out, and being able to use that knowledge to make better trading decisions. That is where the side volume indicator comes in. Let us begin by explaining what the side volume indicator is. The side volume indicator is also known as the volume profile. Imagine being able to see exactly where the most buying and selling activity happened at different price levels. That is what this tool does. Instead of showing you how much trading is happening over time, it shows you where the trading volume took place at each price level. This can help you identify key chart patterns like double tops, double bottoms, head and shoulders formations, triangles, flags, and pennants. These patterns are easier to recognize when you understand where the volume clusters are located. For example, double tops and double bottoms occur when the price reaches the same level twice and fails to break through, forming a resistance or support level. When these formations occur alongside high volume nodes, it adds strength to the likelihood of a reversal happening. Similarly, head and shoulders formations can indicate a change in trend, and when these form at high volume areas, it shows strong market consensus at those levels. Triangles are another important pattern to watch for. Whether ascending, descending, or symmetrical, triangles form as the price consolidates and traders battle for control. Volume plays a crucial role here, as a breakout from the triangle pattern is more convincing if there is significant volume accompanying the move. The side volume indicator helps you see whether there is enough volume to support the breakout, giving you more confidence in your trades. Flags and pennants are continuation patterns that typically form after a strong price move. These patterns are often characterized by a short consolidation period before the trend resumes. Using the side volume indicator, you can see whether the consolidation phase has lower volume compared to the initial move, which is typical of healthy continuation patterns. This helps you gauge whether the trend is likely to continue or if there might be a reversal instead. These patterns are easier to recognize when you understand where the volume clusters are located. This is very helpful because it tells you where traders were most interested in buying or selling, and these areas can become important levels where the price might change direction. Understanding these chart patterns along with volume gives you an extra edge, as you will be able to predict areas of potential breakouts or reversals more accurately. When you can find these levels, you gain a real advantage. You can spot where the price might stop or where it might reverse. Does that sound like something that could help you in your trading? Let us keep going and talk about how the indicator works. Once you apply the side volume indicator, you will see bars on the side of your chart. These bars show how much trading happened at each price level. You will notice some areas have a lot of trading volume, which we call high volume nodes. These high volume nodes are key because they often mark areas of strong support or resistance. These are the places where a lot of buyers and sellers met, and where the market spent a significant amount of time. High volume nodes are often associated with price consolidation or areas where the price struggled to break through, which is why they tend to act as support or resistance. On the other hand, low volume nodes are areas where not much trading happened. These levels are characterized by lower interest, which means there was not a lot of buying or selling activity in those areas. Because of this, price tends to move quickly through low volume nodes, as there is little resistance or support to slow it down. For example, if a price breaks through a high volume node and moves into a low volume area, it can result in a rapid price movement until it finds the next level of significant volume. This phenomenon is often seen in breakout patterns, such as when the price escapes a consolidation zone or a triangle formation. Have you ever seen a price move really fast through a level on a chart? That was probably a low volume area. Understanding the distinction between high volume and low volume nodes can help you anticipate where price might stall, where it might reverse, or where it might move quickly. By recognizing these patterns, you can better position yourself for potential breakout trades, reversals, or even plan where to place stop-loss levels to minimize risk. The side volume indicator gives you insights that are invaluable in reading the underlying market structure and making informed trading decisions. Now that you understand what it is, let us talk about how to set up the side volume indicator in RTrader Pro. First, open RTrader Pro on your device. You will need to select the chart that you want to analyze. Once you have your chart, find the indicator panel. You are going to look for the side volume or volume profile option. It might not be called exactly that, but it will be something related to volume or profile. Once you find it, go ahead and drag it onto your chart. To use it properly, you will want to apply it to a specific range. It could be a trend, a period of consolidation, or just a specific part of the market that you are interested in. The volume bars will then appear on your chart, and now you are ready to read it. Are you excited to see how this can give you more insight into the market? Let us dig in. Let us take a moment to understand how to read the side volume indicator. When you see those high volume nodes, remember they are important. These are price levels where the market traded a lot, and they often act as support or resistance. If the price approaches one of these areas, there is a good chance it will either bounce off or break through. High volume nodes are often found at key chart pattern formations like double tops, double bottoms, and head and shoulders, which make these areas even more significant in terms of market behavior. Another critical level to look for is something called the point of control, or POC for short. This is the price level that had the most trading volume. It is an important level that you want to pay attention to because the price often reacts when it gets close to the POC. When combined with traditional chart patterns such as ascending and descending triangles or flag formations, the POC can give you a clearer indication of whether a breakout is likely to succeed or fail. For instance, if the price approaches the POC while forming a triangle pattern, and there is a surge in volume, it may indicate an impending breakout with conviction. Keep an eye on the low volume nodes too. These areas can help identify regions of quick price movement, which is often seen in patterns like pennants, channels, wedges, and even during breakouts from consolidation zones. Pennants and flags are continuation patterns that typically show a period of rest before the price resumes its original trend. When these patterns form in low volume areas, they can signal the potential for a strong continuation move, especially once the price breaks out of the consolidation phase. Channels, whether ascending, descending, or horizontal, are also influenced by volume levels. Price tends to accelerate when it breaks out of a channel through a low volume node, as there is less resistance or support to slow it down. Another pattern to watch for in low volume areas is the wedge pattern. Both rising and falling wedges indicate a decrease in momentum, and when these form in low volume nodes, it often suggests that a breakout is imminent. Volume is crucial in determining whether the breakout will have enough strength to carry through. When the price moves through these areas, it usually does so quickly, and this can present an opportunity for quick trades if you are ready to act. Have you ever seen the price shoot up or drop quickly and wondered why? It might have been moving through a low volume area, and this rapid movement is typically observed when continuation patterns like pennants or wedges are breaking out, or when price escapes a tight range or channel. Let us talk about how you can use this information in your trading to capture those quick opportunities effectively. Keep an eye on the low volume nodes too. When the price moves through these areas, it usually does so quickly. This can present an opportunity for quick trades if you are ready to act. Have you ever seen the price shoot up or drop quickly and wondered why? It might have been moving through a low volume area. Let us talk about how you can use this information in your trading. When you are using the side volume indicator, start by identifying those strong support and resistance levels based on the high volume nodes. These levels can help you decide where to enter or exit a trade. For example, if the price is approaching a high volume area, you might expect it to struggle to get through that level. If it does break through, it could be a sign of a strong move. However, if it fails to break through, it could reverse direction. This is often seen in chart patterns like double tops or double bottoms. In the case of a double top, the price might test a high volume node twice but fail to break above it, leading to a potential reversal. The same is true for double bottoms, where the price tests a support level twice without breaking lower, suggesting a rebound. Ascending and descending triangles are also important patterns to look for in combination with high volume nodes. In an ascending triangle, the price tends to make higher lows, creating upward pressure against a resistance level. If the resistance level aligns with a high volume node, a breakout is more likely if there is a surge in volume. Conversely, in a descending triangle, price forms lower highs, and a high volume node near the support level can indicate an area where the price may either break down or bounce back. Head and shoulders formations are another key pattern. If a high volume node is present at the neckline of the pattern, it adds significance to a potential breakdown. When the price fails to hold above this neckline and breaks through with strong volume, it often signals a significant reversal. Knowing these levels can help you avoid getting caught off guard and allow you to make more calculated decisions. Identifying high volume nodes in conjunction with these chart patterns gives you a more thorough understanding of market behavior. This insight helps you prepare for possible reversals or continuations and improves your confidence in timing your trades effectively. Let us say the price is moving into a low volume area. You can often expect a quick move through that zone. This is where you can find opportunities for fast trades. This is one of the most exciting parts of using the side volume indicator. It is about being ready for those fast movements. Are you ready to add a little more excitement to your trading? Another way to make the side volume indicator even more powerful is by combining it with other tools. For example, moving averages are great for helping you confirm the direction of the trend. If the price is above a high volume node and above a moving average, it is a stronger signal that the trend is likely to continue. You can also use momentum indicators like the Relative Strength Index, or RSI, and the Moving Average Convergence Divergence, also known as MACD. These indicators can help you decide if a breakout is likely to keep going or if the price might turn around. One of my favorite combinations is the Side Volume Indicator with the VWAP, which stands for Volume Weighted Average Price. The VWAP tells you where the average price is, weighted by volume. When you combine this with the Side Volume Indicator, you can get a clearer picture of where the price is and whether the move is supported by a lot of trading activity. Have you tried using these combinations before? They can make a big difference in how confident you feel about your trades. Let us walk through a practical example to make all of this clear. Imagine the price is trending higher and it is approaching a high volume node. You notice the price starts to slow down and cannot seem to break through that level. This is a classic sign of resistance, and it might be a good time to take profits if you are already in a trade. Alternatively, you might consider shorting the asset if you believe it is likely to reverse. This kind of price action is often seen in double top formations, where the price fails to break above a previous high, especially when volume decreases as it approaches the resistance level. Now imagine a different situation. Let us say the price has been moving sideways for a while, forming a consolidation pattern, and you notice a low volume node just above this consolidation. This area represents low resistance, and if the price breaks out above that level, it might move quickly to the next high volume area. This could be a great trading opportunity, particularly if you spot a pattern like an ascending triangle forming during the consolidation. In an ascending triangle, the price makes higher lows, showing increasing buying pressure, and a breakout through the low volume area can result in a strong upward move. Another scenario might involve a wedge pattern. Suppose the price is consolidating within a falling wedge and is approaching a low volume node. If it breaks out with strong momentum, the absence of significant volume resistance in that area could lead to a rapid price move. These kinds of moves are often high probability trades if you are ready to act swiftly and have the confirmation of volume on your side. How do you usually decide when to enter or exit a trade? Recognizing these key chart patterns, combined with understanding high and low volume nodes, can give you a structured approach to making those decisions more confidently. There are some common mistakes that traders make when using the Side Volume Indicator. One of the biggest mistakes is ignoring price action. The Side Volume Indicator is powerful, but it should not be used alone. You always want to use it alongside price action and other indicators to confirm what you are seeing. For example, if you spot a double top or double bottom pattern, look for corresponding high volume nodes to validate the support or resistance level. Double tops and double bottoms often signal a reversal, especially when the volume profile confirms that there was significant trading activity at those levels. This indicates that market participants were actively defending those price levels. Another mistake is misunderstanding the head and shoulders pattern. In a head and shoulders pattern, the volume typically decreases during the formation of the right shoulder, which often suggests weakening momentum. If the Side Volume Indicator confirms low volume during the right shoulder, it strengthens the expectation of a reversal. High volume nodes at the neckline can also add additional evidence for the potential move when the price breaks down. For ascending or descending triangles, it is crucial to watch how volume behaves. Typically, volume contracts as the price gets closer to the apex of the triangle. When using the Side Volume Indicator, you should look for volume surges to confirm a breakout. If there is a strong volume spike through the high volume node near the boundary of the triangle, it often signals a more reliable breakout. Another mistake is thinking that just because there is a low volume area, it will be an easy trade. Low volume areas can lead to rapid price movement, but they can also lead to unexpected reversals if there is not enough volume to sustain the breakout. Additionally, false breakouts can be especially common in low volume areas, so it is important to use tools like moving averages or momentum indicators to confirm the movement before entering a trade. For example, you might look for moving average crossovers or divergence in momentum indicators like the RSI or MACD to ensure that the breakout has conviction. Patterns such as flags and pennants are often accompanied by low volume consolidations, and you should confirm the breakout using volume increases on the side volume indicator. Similarly, wedge patterns, both rising and falling, can also form in low volume areas. When the price breaks out of these wedge patterns, a surge in volume can indicate that the breakout will be strong and sustained. Another key chart pattern is the cup and handle. In a cup and handle pattern, the handle often forms in a low volume area as the price consolidates before a breakout. If the volume begins to increase as the price breaks out of the handle, this can be a strong indication of continuation. Recognizing these volume shifts within different chart patterns can significantly improve your success rate by helping you differentiate between real and false breakouts. Be careful in choppy markets and do not rush into trades without enough confirmation from multiple sources, such as volume, trend, and momentum. Always make sure that the chart patterns you observe are validated by volume, as this can help distinguish real breakouts from false ones. You can also adapt the side volume indicator to different market conditions by understanding how various chart patterns behave within these contexts. For example, in a trending market, the side volume indicator is excellent for finding strong support and resistance levels, often aligned with high volume nodes. You can use these nodes to see where the trend might pause or even reverse. High volume nodes in an uptrend can often act as consolidation zones, which are crucial for detecting flag or pennant patterns that may lead to continuation of the trend. Similarly, in a downtrend, descending triangles or falling wedges forming at high volume nodes may signal possible reversal points when accompanied by increased volume. In a range-bound market, you will want to focus on the high volume areas at the top and bottom of the range. These levels often provide clues about where the price will bounce. Patterns like double tops or double bottoms are frequently formed at these high volume nodes, giving you strong indications of potential reversals. Additionally, channels formed in range-bound markets can also be better understood using volume. When the price reaches the top or bottom of a channel and aligns with a high volume area, it adds more weight to the likelihood of a reversal. If the market is volatile, the volume profile can help you identify areas where the price might stabilize after rapid price movements. During periods of volatility, patterns like wedges, triangles, or even cup and handle formations may emerge. The volume profile helps you see where high volume nodes are located, and these areas often act as points of stabilization. In particular, if you spot a cup and handle forming during a volatile market condition, seeing volume increase as the handle breaks out can give you confidence in the continuation of the trend. Keeping an eye on these levels can save you from making rushed decisions when the market is moving quickly. By understanding the interaction of different chart patterns with volume nodes in trending, range-bound, and volatile markets, You can adapt your strategy more effectively to suit different conditions and make more informed trading decisions. As we wrap up, let us recap some of the key points we have talked about today. The side volume indicator is an amazing tool for identifying key price levels based on trading activity. High volume areas act as support or resistance, while low volume areas can mean quick price movements. By combining the side volume indicator with other tools like moving averages, momentum indicators, or the VWAP, you can create a strong strategy that will help you make more informed trading decisions. Your next steps are simple. Start applying the side volume indicator to your charts. Practice using it to find support and resistance levels. Combine it with other tools to see how it fits into your overall strategy. Remember, it takes practice to get comfortable with any new tool, but the more you use it, the more it will become second nature. Do not be afraid to experiment with different settings and market conditions. If you have questions, share them. We are all here to learn together, and I am excited to see how you put the side volume indicator to work. Happy trading and best of luck in your journey.